Imagine waking up Friday morning, checking your bank app, and seeing service unavailable. You try calling. Nothing. You drive to the branch. Doors are locked. A federal agent is standing outside. Your bank has failed. What happens to your money? What happens in the first 24 hours? Who gets paid first and why? By the end of this video, you'll understand the exact step-by-step process when a bank collapses, how your money is protected, and what you need to know right now to protect yourself. Let's break it down. First, let's get clear on what bank failure actually means legally. A bank failure occurs when a bank cannot meet its obligations to depositors and is closed by federal or state banking regulators. According to congressional research on bank failures, banks typically fail due to poor management of resources, resulting in inability to meet liquidity or capital requirements. Here's the timeline. Most people never see 90 days before failure. When a bank receives a poor supervisory rating from regulators, the FDIC begins preparation. They download all deposit data, analyze which deposits are insured versus uninsured, and start collecting information on the bank's assets and loans. According to analysis of FDIC bank closure procedures, the agency can deploy up to 100 people for an average-sized bank closure. Friday at close of business. Almost every bank failure happens on Friday evening. Why Friday? It gives the FDIC the weekend to execute the transition before Monday morning when customers need access to their money. The moment regulators close the bank, the FDIC is appointed as receiver. This is critical. The FDIC now operates in two capacities. First, as insurer of deposits up to the legal limit. Second, as receiver tasked with selling the bank's assets and settling its debts. First 48 hours. The FDIC's goal is to make deposit insurance payments within 2 business days of failure. This isn't a suggestion, it's federal law. According to FDIC payment procedures, the agency must pay insured depositors as soon as possible upon institutional failure. During that weekend, one of two things happens. Most commonly, the FDIC arranges what's called a purchase and assumption transaction. A healthy bank purchases some or all of the failed bank's assets and assumes the insured deposits. If you had $30,000 in checking at the failed bank, you wake up Monday morning and that $30,000 is now at the assuming bank. Same money, different institution, access restored. If no healthy bank wants to acquire the failed bank, the FDIC pays depositors directly through what's called a deposit payoff. You receive a check for your insured amount, typically within a few days. Let's talk about what you actually experience as a customer when your bank fails. ATMs and debit cards. The moment the bank is seized, ATMs go dark. Debit cards stop working. This is UND optional. The FDIC needs to freeze all accounts to quickly calculate insurance coverage and prevent further transactions that would complicate the receivership. If there's an acquiring bank, ATMs typically come back online Monday morning. Your debit card may work, or you might need a new one from the acquiring bank. According to FDIC customer procedures, the acquiring bank will accept checks and deposit slips from the failed bank for a short transition period. Direct deposits. If your paycheck, Social Security, or other direct deposits were set up with the failed bank, here's what happens. When there's an acquiring bank, all direct deposits automatically redirect to your new account. The transition is seamless. If there's no acquiring bank, the FDIC typically finds a nearby bank to temporarily handle direct deposit functions. Outstanding checks. If you wrote checks before the bank failed and they haven't cleared yet, those checks will be returned unpaid. They'll be marked to indicate the bank is closed. This does not affect your credit score. It's a mechanical bank closure issue, not a reflection of your financial standing. However, it is your responsibility to make alternative arrangements with whoever received those uncashed checks. Loans? Here's something crucial. Your loans don't disappear. Bank failure does not change your obligation as a borrower. According to federal borrower guidelines for failed banks, you must continue making payments and complying with your loan terms. Within days of the closure, ULL received notification from either the FDIC or the loan's new owner about where to send future payments. The FDIC aims to sell loan portfolios quickly, typically within a few months, to return assets to the private sector as efficiently as possible. Now, let's talk about the money. Who gets paid, how much, and in what order? The FDIC insures deposits up to $250,000 per depositor, per bank, per ownership category. According to deposit insurance regulations, this includes principal and accrued interest through the date of the bank's closure. If you have $230,000 in a checking account, you're fully covered. Payment priority by law. Federal law establishes a clear hierarchy. According to the FDIC's priority of payments, after administrative costs are covered, the order is 1. Insured depositors up to $250,000 per person. Per ownership category 2. Uninsured depositors amounts above $250,000 3. General creditors 4. Shareholders. This order is legally mandated and cannot be changed. In most cases, general creditors and shareholders receive little or no recovery. Why depositors before creditors? It's called depositor preference. Your deposits are prioritized over business debts because deposit insurance exists to prevent bank runs and maintain confidence in the banking system. What happens above $250,000? If you have uninsured deposits, you don't lose that money immediately. You receive what's called a receiver certificate. This represents your claim against the failed bank's remaining assets. As the FDIC sells the bank's assets, loans, real estate, equipment, uninsured depositors receive periodic dividend payments on a pro rata basis. According to receivership procedures, advanced dividends often range from 1/3 to 1/2 of the uninsured amount and are typically paid within 30 days. But here's the reality. It can take years to fully liquidate a failed bank's assets. Average disposition times range from 6 to 12 months, but complex situations can take longer. In March 2023, something extraordinary happened. Silicon Valley Bank and Signature Bank failed. They had $231 billion in combined uninsured deposits. The government invoked what's called the systemic risk exception. The Treasury Secretary, FDIC, and Federal Reserve determined that not protecting uninsured deposits would cause serious adverse economic effects and financial instability. But here's what's critical. According to subsequent government statements on deposit insurance policy, this was an exception, not a new standard. Future bank failures will default back to the $250,000 limit. The FDIC and Treasury were explicit: do not count on the government bailing out uninsured deposits in the future. The systemic risk exception requires a 2/3 vote from the FDIC board, a 2/3 vote from the Federal Reserve Board, and approval from the Treasury Secretary in consultation with the President. It is designed for scenarios where the entire financial system is at risk, not for routine bank failures. Let me clear up some dangerous myths about bank failures. Myth 1. The FDIC doesn't have enough money to cover all deposits. The FDIC's Deposit Insurance Fund had $128.2 billion as of December 2022. That doesn't need to cover all $22 trillion in the banking system. It only needs to cover insured deposits at failed institutions. Since 1934, no depositor has ever lost a penny of FDIC-insured deposits. The fund is backed by the full faith and credit of the U.S. government through a direct line of credit with the Treasury. Myth 2. Multiple accounts at the same bank. Multiply my coverage. Wrong. Coverage is $250,000 per depositor, per bank, Per ownership category, if you have $150,000 in checking and $150,000 in savings at the same bank under the same ownership type, you have $50,000 uninsured. Different branches of the same bank don't count as separate banks. Myth 3. Bank failures mean I lose everything immediately. For insured amounts, you have access within 2 business days. For uninsured amounts, you receive an advance dividend, typically within 30 days, and additional payments as assets are sold. Here's what you need to do today to protect yourself before any failure happens. Strategy 1. Understand ownership categories. You can have more than $250,000 insured at one bank through different ownership categories. Single accounts, joint accounts, certain retirement accounts, trust accounts. Each category gets separate $250,000 coverage. According to FDIC insurance guidelines, a trust owner with 5 beneficiaries can have up to $250,000 insured at a single bank. Strategy 2. Spread deposits across banks. If you have $500,000, put $250,000 at Bank A and $250,000 at Bank B. Each is fully insured. Do 1. Put multiple accounts at branches of the same bank thinking you've a multiplied coverage. You haven't. Strategy 3. Use reciprocal deposit networks. Services like IntraFi automatically distribute your deposits across multiple FDIC-insured banks in their network. You maintain one relationship but get multi-million-dollar coverage. Some banks like SoFi provide up to $3 million in coverage through automatic distribution to partner institutions. Strategy 4. Know your bank's health. The FDIC maintains lists of troubled banks. While individual names aren't public, your bank's quarterly reports and regulatory ratings can signal problems. Pay attention to news about your institution's financial stability. So what actually happens if your bank shuts down? The FDIC seizes it on a Friday. Within 48 hours, you either have your insured deposits transferred to an acquiring bank or receive payment directly. ATMs come back online Monday morning if there's an acquirer. Direct deposits redirect automatically. Your loans continue. You still owe them. Insured depositors get paid first, up to $250,000. Uninsured depositors get partial payment within 30 days and potential additional dividends as assets are sold. Creditors come next. Shareholders last. The system protects you, but only up to the legal limit. If you have more than $250,000 at a single bank in a single ownership category, you have exposure. Fix that today. Between 2001 and 2020, 561 banks failed. The FDIC handled every single one, and no insured depositor lost money. Bank failures aren't common, but they happen. Understanding this process is ENA's about fear. It's about being prepared and protecting what you've worked for. If you found this breakdown valuable, hit subscribe. We're demystifying how the financial system actually works, one topic at a time.